The growth in Kenya's financial services sector has seen banks enjoy record profits, boosted partly by increased loan accounts and the corresponding higher interest income. According to the central bank, loan accounts grew from 1.2 million in 2007 to 2.1 million in 2010 as banks aggressively hawked loans to willing borrowers. When the central bank lowered its lending rates to commercial banks, the banks reciprocated by offering accessible loans to consumers. But with rising interest rates, what might have looked like a relatively cheap loan last year but one may not be the case now. Since last week, 7 banks have increased their base lending rates in a move that analysts say may be attributed to the recent increase in CBK's lending rate from 6.25% to the overnight discount window rate of 8%.
If the rate goes up, it's just like water going up, then the interest rate on your loan is definitely going to go up.
For instance, a 1 million shilling loan taken at 17% interest payable in 5 years would see a borrower pay interest of over 491,000 shillings. But a slight change in the interest rate from 17% to 18.5% raises the total interest to over 539,000, a 48,000 shilling increase. Now CBK has cautioned banks against the move, which the governor says could result in lenders overpricing themselves out of the market.
If you price yourself out of the market, it's only you to blame.
Analysts now advise that when taking a loan, negotiate your interest rate with the bank if possible. Wanjiru Gaidho, Citizen Business.